All right, in this episode, I'm going to talk with Brett Tomach of Greenbacker Renewable Energy Company. This is Impact Financial Planners. I'm Bill Holliday. Impact Financial Planners is a fee-only financial planning firm specializing in sustainable, responsible impact investing at impactfinancialplanners.com. Thank you for joining us. This is an interview about a company that buys up alternative energy facilities, solar, mostly solar plants, some wind plants, and then they have this big portfolio of them that they'll eventually sell to a large investor or make it public. It does get a little in the weeds, so bear with me. I think it's still a valuable interview. All right, let's go to the interview.
Are you familiar with an RPS, or Renewable Portfolio Standard?
No.
So that's a requirement by a state to get to a certain level of electricity produced from renewable sources by a certain time.
Okay.
So I'm out here in California, and last year, Governor Jerry Brown put into place SB 100, which is going to require the state of California and the utility companies to get to 100% of their electricity generated from clean sources by 2045. So a clean source or a carbon-free source is not 100% renewables or wind, solar, biomass, etc. So that includes natural gas, include nuclear electricity, so on and so forth. But what's interesting about the standard he put in place is that 60% of that 100% is going to have to come from renewable sources, so wind and solar. And what we're seeing nationwide is not only are we seeing more states add renewable portfolio standards, but we're seeing those that do have renewable portfolio standards growing them or enhancing them, which it just goes to show you the incredible amount of kind of groundswell there is in the renewable space, and then also that a lot of these policies are driven on the state level. I mean, that's one of the biggest questions I get is, how much does the current administration impact, renewable energy, the growth of renewable energy throughout the country? And my response is always not much. There may be some funding pulled on the research and development side, but ultimately a lot of it's driven on, the state and the local government side of things.
How many states have this goal of
38 right now.
Oh, wow. Okay.
Yeah. So it's a good amount, and like Maryland just bumped up to 50%. I forget the exact date. It's supposed to get to 50%. Nevada bumped up to 50% as well. We've seen Maine increase theirs over the last month or two. We're seeing New York and New Jersey also push up to 100%, similar to California. So there's a tremendous amount of activity in the space, which is very encouraging. And those are the states that usually we'll participate in. Our current fund, we operate in 20 states throughout the country. For the most part, all of them have, pretty progressive renewable portfolio standards in place.
And it's on the state level. It's not a corporate decision or at a smaller level, or that's where you're mostly seeing it.
That's correct.
Driven by states. Could you just explain what biomass is?
Yeah, so I'll speak specifically to our deal that we have in Colorado. And Colorado's kind of inflicted with a similar situation to what we have in California, where the forests are being overrun by beetles. And the reason that the beetles are overrunning the forest is due to droughts that we've had, not only in California, but in Colorado as well. And what they're doing is they're killing the timber in the forests. So ultimately, the Forestry Service and national parks and the states and the cities have to do something with the dead timber to prevent forest fires, which, unfortunately we're impacted by on a yearly basis. And so in Colorado, in the specific deal that we acquired out in Gypsum, what they're doing is they're taking the dead timber from the beetles, and that's going to be burned, and that process generates electricity.
Okay, gotcha.
That makes sense. So, the important thing when buying a biomass deal is the feedstock. So, you want to have a reliable source of timber. So not only do we have contracts to sell electricity to the city of Gypsum and Vail, but we also have a contract with the federal government and Forestry Service for the timber necessary to continue to burn.
Gotcha.
So it's going to have to be burned either way. Some people, that's one of the big things with biomass as a renewable source. They're like, well, you're burning fuel, essentially burning wood, which is not, the greenest of processes. But it's going to have to be burned either way, so we might as well put it to good use.
Sure, you might as well harvest that energy.
Exactly. And the reason that's specifically great for Greenbacker and as an investment strategy is if you take a look at solar and wind, it's very cyclical. So, obviously the sun is going to be out more from March to November, and it's going to be out a lot less from November through the winter or fall and winter. We've historically found the production goes down in those months. And so we supplemented that with wind, which is also fairly unpredictable, but we definitely see wind increases through the winter months. But the great thing about the biomass deal is that we'll be burning the wood to generate electricity 20 out of 24 hours a day. So it helps smooth out the productivity of the production and the cash flow of our portfolio.
Cool. Well, let me just back up a little. First, Brett, thank you for joining me on this, or agreeing to be interviewed. So you're with Greenbacker Renewable Energy Company.
Correct.
That's the overriding. And you currently have an offering out there. Could you just discuss the strategy?
Yeah. So our investment thesis is that we acquire and we manage a nationwide portfolio of renewable energy assets with which we sell the electricity generated from those assets to investment grade or high quality utility companies. So, our off-taker list consists of Duke Energy, Dominion, Southern California Edison, San Diego Gas and Electric, a whole host of municipalities, for example, the city of Denver, and then some other, private universities or institutions. So, we're generating electricity and we sell that electricity to these entities for a return, which is used to pay investors. One of the huge advantages of the investment is going to be the tax incentive on the distribution that we pay. So our investment is 100% tax deferred, meaning on an annual basis, investors are not going to have a tax liability. On the back end, when the portfolio is sold, they're going to be responsible for long-term capital gains on the difference between what's returned and their adjusted cost basis. So that's a huge tax advantage, and there's going to be no recapture on the back end, which is great. And that's not due to any kind of crafty accounting or incentive tax credits. That's one of the biggest questions I get is, with the incentive tax credits sunsetting, how is that going to impact the portfolio? Well, from a kind of tax deferral standpoint, it doesn't at all. So energy assets on the whole, whether it's gas, coal, natural gas, renewable energy, are all depreciated on an 11-year schedule compared to with real estate on a 26-year schedule. So within our structure, investment structure, we're able to shelter the taxes through that. So all distributions that we pay to investors are treated as long-term capital gains on the back end. So the opportunity within renewable energy is really driven off two things. First and foremost, the falling cost of solar. If you look at the historical, cost curve, we always like to date it back to the 70s when Jimmy Carter put solar panels on the roof of the White House, which Ronald Reagan immediately took down. But at that time, it was $77 per watt to produce 1 watt of new photovoltaic solar energy. Fast forward to 2019, it's down to 30 cents. We've seen that cost curve over the last 10 years drop, close to 95, 98%, which is tremendous. The pivotal year was 2016 when utility scale wind and solar became the two cheapest forms of new energy generation available. So, at that point, we were no longer relying on subsidies or, incentive tax credits to generate great returns. And then the second opportunity, as I touched on earlier, is the renewable portfolio standards. They're being put in throughout the country, and It's just driving tons of development in the space. So, we're not developers. We don't like to take any developmental risk. every deal that we enter into, there needs to be a site picked out. We do not own the land, we lease the land. So there needs to be a site picked out, a long-term contract in place, and then also interconnection to the transmission lines. And so, as I mentioned, we sell electricity, and the electricity is sold through long-term contracts. Right now on our portfolio, the average contract length is about 17 and a half years.
Wait, so you're renting the land, you're leasing the energy out, but the solar field isn't put in place. You'll put that in place? Or are you
Yes.
buying it already assembled?
So we lease the land. For the most part, the land is undesirable, whether it be a rooftop or it be a mountain pass where we have a wind farm. So for instance, we own the solar panels that surround the Denver International Airport. We sell the electricity to the airport as well as the city of Denver. We lease that land for $1 a year, and we have a 50-year lease.
Great.
Yeah. So that's one example of
But
kind
then
of
the fund is buying the panels and installing them.
exactly. Okay. So there are, I'll call it 3 types of deals that we'll look to enter into. The first are kind of special or opportunistic deals, where we believe that our expertise in the renewable energy space, we can boost the curve or the production of that asset. We find those periodically, but that's not our bread and butter. The next is their operational assets, where we are buying the panels and we are essentially buying it on the contract, but we think that we can enhance the production of that asset. So all of our contracts are what's called take or pay. So no matter how much or how little electricity we generate from that asset, the utility company on the other end, our counterparty, is responsible for buying that electricity. So if we can enhance the production by 10 or 20%, they're going to be on the hook for buying that additional electricity that's generated.
Okay.
And then the third type of deal, which we've recently started getting into, I'd say over the last year and a half, is called an NTP, or notice to proceed. So as I mentioned, we're not taking any development risk, but we will take the construction risk. So development in our eyes is negotiating the long-term contract, finding the site to put the panels, and the interconnection to the transmission line. So if all that is in place, we'll go into a purchase agreement to buy that deal, and then we will actually build the solar field ourselves. So we'll order the panels and we'll construct it.
Gotcha. And how is the competition right now? I mean, is there more demand than supply currently, or are other utilities building fields as well? And
no, it's very regionally based. I think and it's also dependent on utility companies. Different states have different standards as to whether or not utility companies can kind of own their power generation facilities. Some do, some don't. Some say you can own a certain percentage of them, others you can't. I think another important thing for me to point out is the fact that we're not buying the large, 100, 200 megawatt deals, the 200, 300, $400 million deals. We're focused on smaller and medium-sized deals. And that's where the inefficiency in the kind of solar and wind market lies. We're seeing a lot of, we'll call it indirect competition, but other kind of institutional investors get into the larger deals. The BlackRocks, Warren Buffett's the largest private owner of renewable energy assets in the country, and he's buying the biggest deals. Goldman Sachs just came out with an energy infrastructure fund, investing in those large deals, but the number of folks that are competing in our space in the smaller and medium-sized deals is a lot fewer. So our biggest deal today is about 60 megawatts. Yeah. So we're focused on the smaller end of the market, and there's not a ton of competition when you look at our nationwide portfolio. So you'll see some. I know there's a small outfit out in Oregon. There's a small outfit out in Massachusetts, but nobody kind of on a national scale.
Okay, so you see room to grow and continue doing what you're doing.
Absolutely, and you're seeing a ton of investment in renewable or sustainable infrastructure. I think, I don't know the exact number of years, but the last few years, investments in sustainable infrastructure, so renewable sources, outpace traditional forms of energy generation. Handily, I think it's like 55 or 60% of investment in new energy generation went into renewables, solar and wind specifically, instead of coal and natural gas. We're seeing also a ton of the power plants, the coal power plants, being shut down as well nationwide.
Sure. Yeah. So this fund that you have, it started what, about 4 years ago?
Yes. Yeah.
4 years ago.
2014, the beginning of 2014.
14. Okay. And it's been growing. You've been receiving money to buy up more facilities. And then at some point that's going to close and be done. And you're saying within a year that's done for new money. And you'll just hold that operation for what, a couple years, and then it'll have a liquidation event.
Yeah,
portfolio.
by prospectus, 3 to 5 years before there's a liquidity event.
Okay. So it'll close in a year, and then 3 to 5 years, and then it'll sell off somewhere. I mean, what's a liquidity event? An example, I guess.
So, our kind of thought on that topic right now is twofold. I was talking about kind of the larger deals that are out there right now. We have the idea that if we can aggregate and streamline a portfolio of that size, the larger deals that a lot of these institutions like, we can get a premium for that because we've seen the cap rates in that market come down significantly. Those deals right now are being acquired at 4s, 5s, and 6s, where we're buying ours at 7, 8, and 9 cap rates. So even if we can get a % of compression on an aggregated portfolio, that's a great return for investors.
All right, that went a little over my head. Cap rate meaning what?
It's similar to real estate. It's how much it's cash flowing versus the value of the asset.
Oh, gotcha. Okay.
Yeah,
So
yeah.
you're leveraged a little, or you're getting a better return on assets than the bigger funds are. So this would be a nice addition for them.
Exactly. It'd be a great addition.
So you could get bought out by a bigger, or you could sell the portfolio to a bigger fund, I guess.
Yes, we could.
Okay. And then, so what's in the future? What are you?
We're an insurance company. We've definitely been courted by and had insurance companies inquire about our portfolio. Obviously, the predictable cash flow of these 20, 25-year contracts matches up well with their liabilities.
Okay. And so what's the next thing? I mean, I've heard about the opportunity zone and possibly Greenbacker 2. What do you see as the next investment opportunity through Greenbacker?
Yeah, so beginning of July, we came out with an opportunity zone investment, and it seemed like a natural progression for the business. Based on what I was speaking to earlier, the NTP deals, which is the notice to proceed deals. Those are the ones that still have to be actually physically constructed. And what we found is that 20% of our existing portfolio is made up of NTP deals that fall within opportunity zones. Obviously we're looking for less desirable land. So, we're not going to be building a solar farm in Beverly Hills.
Right.
It's going to be in, one of these that's considered economically depressed areas. Although, if you take a look at the map, there could be some questions about kind of the validity of whether or not these areas are economically depressed. But the whole premise behind opportunity zones, I'm not sure if you talked to it before, is economic development in areas that kind of haven't seen economic development or need it. As I mentioned, economically depressed areas. And so opportunity zone investments in our space, we need to acquire a deal before it gets turned on. Does that make sense?
You need to acquire a selling contract, you mean?
So in our, with those NTP deals, as I mentioned, those contracts are already in place, but it's literally like the switch is flipped for the facility to go on. So it could be constructed, but having never generated a single megawatt of electricity, If we buy it like the day before it gets turned on, that asset starts producing electricity, it can be
Yeah.
considered an opportunity zone investment if it falls into one of those geographical areas. So,
Gotcha.
we have 5 deals that are earmarked to go into the opportunity zone fund here shortly. And we expect them all to be cash flowing by Q4 of this year.
Okay. And the opportunity zone, just to be clear, I guess, or to explain, those are areas throughout the United States and areas that the government's trying to encourage development. And
Exactly.
so there's a capital gains break on that.
Yeah, so the idea behind it is, if you have gains from a real estate sale, a business sale, or in your equities portfolio, you're essentially going to sell off that gain and roll it into a qualified opportunity zone investment. And there are 3 pieces to the opportunity zone investment. In year 5, you'll get a step up in basis on that gain of 10%. At year 7, you'll get an additional 5% step up in basis on that gain. So a total of 15% after year 7. And then if the investment is held for 10 years, you will not owe any taxes on the gains that's generated from that qualified opportunity zone investment.
On the new capital gains, you don't have to pay on it.
Exactly. So you'll get a step up in basis of 15% on the old gains.
Yeah.
And there'll be no tax liability or responsibility for any of the gains generated from the new investment.
Right. Which is a nice break. So if you have a big capital gains, you can delay it 7 years, get 15% forgiven, and then the new investment isn't generating any new capital gains.
Exactly.
Okay. Yeah, no, that's great. That's a great idea.
Yeah.
And is that hard for you to qualify? Or you're saying a lot of the areas you're looking for kind of fall into this range, so it's a pretty good.
Yeah, as I mentioned, about 20% of the assets, or 20% of the fund, our existing fund, fell into opportunity zones already.
Okay.
And so, right now, I think in speaking to our deal team recently, we're looking to raise $200 million. We have about $100 million in pipeline that we've kind of set aside to go into the opportunity zone. So, there is a tremendous amount of opportunity in that space. As I mentioned, a lot of the assets that we're buying are in kind of, economically undesirable areas to begin with.
That's interesting too. I remember there's also criteria that you invest a certain amount of money at certain points in to qualify for the opportunity zone funding. Is that easy for you to meet with?
Yeah, so we're not an opportunity zone, real estate investment or an opportunity zone property. We're technically considered an opportunity zone business.
Oh.
So that is not part of our criteria.
Okay.
The criteria that we have to meet is that it's new development or essentially a new asset or a new business in the area. So as I said, if we actually build the solar farm and started producing electricity, that's considered new development. And the point that has to be in the opportunity zone is where the interconnection to the transmission lines falls.
Okay.
Yeah.
That's interesting. So
our business, we operate out of, our headquarters is in New York City.
Okay.
So people are, and also, if we're selling electricity to, say, Southern California Edison, where does that fall? And so the rules are it's where the electricity is sold, which is at the point of interconnection to the transmission lines.
Oh, that's interesting. So it's not necessarily where its solar field is. It's just where you connect it.
Exactly.
Okay.
Yeah.
And that's an existing fund, and that's how long is that going to be open or available, or what's its life cycle?
Existing fund, it's $100,000 minimums, and the fund close date is going to be June 2020. That's our planned close date, although we expect it to close down before that. We've already gained a tremendous amount of traction. Being able to go back to an existing investor base and introduce a topical investment that's not different from what they're already currently invested it's easy for us to get interest in this fund, and it's been very well received. I feel like in a lot of the conversations that I've been having with RAs throughout the country, I've found that a lot of the risks that people are seeing in real estate based opportunities on investments, we mitigate, particularly with the development. If you're going to buy, first of all, we're 10 years into a real estate bull market, which is not the most opportune time to be developing new real estate,
Right.
especially in an area that's considered economically depressed. Usually that development of real estate assets going to take 1, 2, 3 years, and then you're going to have to tenant it. So you're looking at a few years before there's cash flow. As I mentioned, the 5 deals that we're putting into the fund immediately, we expect them to be cash flowing in Q4 of this year, which is exciting.
Wow.
Yeah, so it's been well received.
So if someone has 20,000 of capital gains they want to mitigate during the year, they don't necessarily have to invest. I mean, they'd invest 100,000, but it doesn't all have to be capital gains money. Or it should be all capital gains money that year.
If someone was not rolling a capital gains into our investment, or if that was an idea that was brought to me, I would suggest that they go into our flagship offering. The tax advantages for them are probably going to be greater in our flagship offering. Plus, they're going to be receiving cash flow throughout that investment. Whereas with the opportunity zone, the whole premise behind it is building the gain to as much as possible to defer that. And so that we're not going to be paying any distributions. All cash flow from the assets is going to be reinvested to pay down debt and buy new assets.
Gotcha.
So I would suggest that they invest that additional $80,000 that they had it into Greenbacker Renewable Energy Company.
The right, into the initial one. Okay, great. And the opportunity zone will have a similar life of it'll shut down, and then 3 to 5 years it'll have some kind of liquidation event.
No, as I mentioned earlier, there are kind of 3.
Oh no, that's right. It'll have to go.
We're going to be holding it for at least 10 years.
Okay.
Yeah, probably longer. But at the 10-year mark, you'll be able to get out.
All right. Yeah, that makes sense. So that they can get the full benefit of the fund, and then
the intent is definitely to find investors that have gains that they don't need over the next 10 years.
Right.
That's the premise behind it. Yeah.
Right. No, that makes sense.
Yeah.
Okay, great. And what are you seeing in the renewable energy field, any trends? I mean, is it both solar, wind growing similarly?
Yeah, I'd say we're seeing more solar growth. And as I mentioned earlier with the renewable portfolio standards, I just think you're going to continue to see those increase, and you're going to see the need for more development. I mean, there's a lot of legislation that's being pushed through that's driving all of this. The other trend that's interesting is we're seeing the current incentive tax or investment tax credits attached to renewable energy assets. That's sunsetting starting next year, and there'll be some assets that are grandfathered in. So we're seeing a ton of development in this space, which has been positive, and it's been allowing us to go out there and acquire some great deals. And I also see a lot of utility companies, or more utility companies based on the RPSs, looking to buy more deals.
Sure.
Or get more of their electricity from renewable assets. And also, another interesting thing on a side note is we've seen our cost of capital fall dramatically from when we started. So we just extended our credit facility from 60 million to 110, and we saw our cost of capital drop 50 basis points, which is more than we had modeled out for. And that's due to just the level of comfort and kind of the validation of this strategy that the banks have seen. So we partner with a lot of banks on these deals, and they're seeing more institutional investors coming into the space. They're investing more dollars into the renewable energy space. So as I mentioned, their level of comfort with investing or lending on renewable assets is definitely increasing.
That's great. No,
Yeah.
that's nice that they're comfortable with that. And I think with long-term agreements, they've got to be pretty comfortable
Absolutely.
with
Absolutely.
that. And then you mentioned that Greenbacker, if that kind of closes, you don't have a plan for Greenbacker 2 yet, but the direction you're going is a little bit more liquid of an investment, would be your thought?
Yeah, we see a lot of, I don't know if competitors is the right word, but we see a lot of kind of alternative or illiquid asset managers moving into the Reg D space. So Reg D is a private offering. And, rather than kind of following that trend, we think there's a lot of appeal in going back into the kind of the public market and having a public offering that's a lot more transparent and it's a lot more accessible for the investors that you would have, the retail investors. So that's the conversations that I'm hearing internally. I'm kind of thinking, we're going to be moving along those lines.
And your next offering would probably be sometime next year after the other two have closed up.
Correct. I imagine it'll come out shortly after we close down this fund, if not, a month or two after.
Oh, okay, good. All right. So there's always going to be something people could invest in.
Yeah, I don't think my boss would want to pay me while, just sit on my hands while I come out with a new fund.
With nothing available to raise money for.
Exactly.
If people want to find out more, where can they find information?
Greenbackercapital.com.
Great.
We have information on there for our existing fund, Greenbacker Renewable Energy Company, as well as the Opportunity Zone, Greenbacker Renewable Opportunity Zone Fund.
Perfect. And if people want to get in touch with you, what's your best contact?
Brett.Tomach, Tomich, at greenbackercapital.com. And that's Brett with 2 T's.
Oh, yeah, Brett with 2 T's. Okay, got it. I'll put a link on the show notes.
Okay.
All right, Brett, thank you very much for your time.
Of course. Thank you, Bill.
Thank you for listening to Impact Financial Planners. This podcast is for informational use only. We are not making investment recommendations. This is not an appropriate investment for everyone. As with any investment, please read the prospectus and discuss it with your financial planner. This has been brought to you by Impact Financial Planners. If you need help with any part of your finances, please contact Impact Financial Planners for a free meeting, impactfinancialplanners.com. We have a free informational ebook on our website about sustainable, responsible impact investing. If you want to learn more about making an impact with your investments, about investing in line with your values, it's at impactfinancialplanners.com/SRI ebook. All right, as always, I appreciate any feedback you have. Please leave a comment. Contact me if you have any questions. And if you like these podcasts and videos, please rate them, put a review. Really appreciate it. All right, thanks a lot.